My name is Eric. I'm our Chief Revenue Officer here at NEO and your host for today's presentation. Welcome to the latest installment of the NEO Presents series of events. Today's session, The Moment for Modernization. It's both relevant and timely given the recent report laid out by the Capital Markets Modernization Taskforce on July the 9th, with comments being accepted until September the 7th. This is the time to make your voice heard. We'd like to thank our sponsors who have loaned their support to ensure this is a well-attended event by those of you who have an interest in the fair and efficient functioning of our capital markets. Our thanks and gratitude to Osler, Hoskins and Harcourt, Miller Thompson, Wildeboer Delis, Borden, Ladner Gervais, Odyssey Trust Company, Denton's, and Baker McKenzie. Thank you. Now to the main event, to introduce our participants and panelists, whom I'm certain will ensure this is an insightful and lively discussion over lunch. Our moderator, Mark Rendell, capital markets reporter with the Globe and Mail. Cindy Tripp, our keynote speaker, founding partner and former co-head of trading with GMP Securities, also a member of the task force. And our panelists, Sheila Murray, corporate director and former president of CI Financial, Neil Self, CEO and Managing Principal of Infor Financial, Rob Wildeboer, Executive Chairman and Co-founder of Martin Rea International, and NEO's own Jos Schmitt, President and CEO of NEO. Let's get straight to it. Cindy, I'll hand the microphone over to you to kick us off.
Thank you, Eric. And thanks to NEO for hosting this event. The Capital Markets Modernization Taskforce was created in February by Ontario Minister of Finance, Rod Phillips. It was created to review the Securities Act and to modernize our capital markets. The task force is chaired by Waleed Solomon, and the other members are Melissa Kennedy, Wes Hall, Rupert Duchesne, and me. We know that a vibrant economy needs a vibrant capital markets, and they need to be driven by innovation, competition, and diversity. Minister Phillips tasked us with developing bold recommendations to solve not only yesterday's problems, but to ensure that our regulatory structure will keep up with the rapidly changing capital markets. Ontario capital's markets are a critical part of our economy, and a modern structure, a modern regulatory structure, is going to help us be more attractive to global capital. Since February, we've met with over 110 stakeholders, and they're mostly in environments like this over Zoom. We've listened to the challenges they face and to some of their complaints. And of course, more importantly, their ideas about how to strengthen our capital markets. We met with entrepreneurs, exchanges, public companies, investor advocacy groups, regulators, dealers, both big and small, academics, and of course, our law firms. From these meetings, we published a consultation paper that came out in early July, which outlines 47 potential recommendations. The comment period for the stakeholder report ends shortly, September the 7th, and I encourage everyone to provide written feedback on any or all of the proposed recommendations. We're going to spend the next couple of months reviewing that feedback, and we intend to publish a final report to Minister Phillips by the end of the year. From there, it'll be the government's prerogative to decide which of those recommendations they'd like to implement. Some of the recommendations can be implemented with amendments to the Securities Act. Some will require OSC rule amendments, while others will require working with our CSA partners to amend national instruments. The consultations paper's 47 recommendations cover a lot of different areas in Ontario's capital markets. And for the sake of time, in my 10 minutes this morning, I'm going to focus on a couple of themes: making issuers' lives easier, helping issuers and dealers to raise more capital, ensuring that regulators have the right focus and the right tools for success, ensuring our capital markets have competition and diversity. Making issuers' lives easier. In general, we heard feedback that issuers face ever-increasing costs in order to operate as a public company. If we want to attract more companies to Ontario, the status quo must be improved. In this area, we recommended reforming continuous disclosure by allowing firms to adopt semi-annual financial reporting, should they wish to, by merging the AIF and MD&A forms, and by simplifying bar reporting. We've also recommended adopting access equals delivery model for disclosure documents. This is critical for a transition to a digital economy, which COVID-19 has shown is coming a lot quicker than any of us had expected. We've also provided a number of recommendations that will give issuers greater rights when they are working with proxy advisor firms. Second theme, helping issuers and dealers to raise capital. We heard repeatedly in our consultation meetings that it's become more difficult to raise capital, and that is particularly for smaller issuers. We want to reform and create more ways to access, for issuers to access capital. Stakeholders also made it clear that where it's possible, we should harmonize with US rules. A couple of examples in this area: eliminating the 4-month hold for securities sold to accredited investors by reporting issuers, expanding the accredited investor definition by adding proficiency, and a couple of examples that relate to adopting US rules. One is adopting the US testing the waters rules to allow reporting issuers and their dealers to pre-market public offerings. And the WICSI model, the well-known seasoned issuer model, where large issuers who meet certain thresholds, of course, will be able to file a prospectus with no regulatory review. Third theme, ensuring regulators have the right focus and those right tools. Based on stakeholder feedback, we have recommended that the mandate of the OSC be expanded to include fostering capital formation and competition in our markets. This is to help ensure a more balanced approach to regulation that will encourage growth and confidence in our capital markets. The one item where we had almost universal stakeholder consensus was the need to separate the regulatory and adjudicative functions of the OSC. In addition to that, we're recommending that the OSC chair and CEO role be split so that the OSC will mirror the governance practices of the companies that they regulate. With respect to regulator tools, we heard feedback on the enforcement system and on investor protection. Both are critical to ensuring confidence in our capital markets. A couple of examples in this area is an increase to the maximum monetary penalty for the breach of securities law from $1 million, which has not changed since 2003, to $5 million. A broadening of the tools that the OSC has to actually collect those sanctions. In 2019, the OSC was only able to collect 35% of the monetary sanctions that they levied. And finally, to provide OBSI, the ombudsman for both IROC and MFDA firms, to have binding authority over their dispute resolution services. The fourth theme is competition. Canada's financial ecosystem is uniquely concentrated with a few big players. And we heard from many stakeholders the importance of ensuring competition, not just for the sake of competition, to make sure that our next generation of innovators and smaller companies can find success in Ontario. There's 2 recommendations in the report that are geared around competition. The first is a proposal to restrict the bundling of commercial lending and underwriting services, as well as to amend the definition of a connected issuer to include commercial lenders, or I guess related commercial lenders. We have heard that tide selling is harmful to independent investment dealers, and it conflicts with the delivery of independent advice to issuers. Furthermore, it's contributed to the steady decline of independent dealers over the past decade, which in turn will limit the access of capital to, again, those smaller and startup companies. The second area of competition was that we heard from many independent fund manufacturers that it's increasingly difficult for them to get their products on the bank retail shelves. While we know that the impact of the client-focused reforms that come into force next year will address some of these concerns, we're asking for feedback on other resolutions. Should banks be forced to report how much proprietary product they sell? Should they report that as a percentage of the total product they sell? Should they be allowed to sell only proprietary products in some of their channels? And should manufacturers have recourse when their products are unreasonably refused from a shelf? Lastly, I just want to highlight our recommendations for greater board diversity, which has received some media coverage, and I know that some of my fellow panel members definitely have comments on. With respect to diversity, I think we're simply asking the question, is it time to move past comply or explain? Since it was implemented in 2014, we know that progress has been slow. 22% of companies have adopted targets relating to the representation of women on boards. Our proposal is simply to have established public companies report on their progress alongside a target that they can be benchmarked to. We propose that those targets include BIPOC, Black, Indigenous, and people of color, as well as women, and that they should apply both to executive officer positions and to the board. And we've asked for input on what the target should be and how long companies should have to comply. Together, the task force work will modernize our capital markets regulatory framework so we will support and sustain a healthy and prosperous capital markets. Thank you. That concludes my remarks, and I think I turn it back to Eric now.
Thank you, Cindy. Thank you for the clear vision and lens through which the task force has written its report, what's been happening in the past, and where you see a clear path for change. With that, the main event. Mark, over to you.
Thanks, Eric. Thanks, everybody, for attending today. We have a fantastic group of panelists, a lot of expertise between and among the group on all these issues. So it's going to be a good and hopefully lively discussion. We have quite a lot of ground to cover in the next, call it 45 minutes or so. So I'm going to try to get to as many questions as we can. I would also encourage people who are listening to send in questions as well. There's a little Q&A box at the bottom of your Zoom call. You can type into that. That will pop up. I'll see it, and I'll be able to direct the questions onto our panelists. So just kind of diving in, perhaps let's start with a bigger picture question. There's a sense that the mandate of the OSC needs to change to encourage, more competition, more capital formation, that perhaps the previous focus on investor protection has been to the detriment of the development and growth of the markets. And I'm wondering, perhaps starting with you, Rob, would changing the mandate do much to kind of alter that focus on investor protection? And is that a positive move to make?
Well, I hope so. First of all, I want to thank the work of the commission, or effectively the panel. I think it's done a great job. I think it's always good to go back to first principles. Why do we do what we do? Why do we regulate? What's the purpose of securities regulation? I actually believe that effective capital markets is at the core of what we need here. We get there by making it possible to raise capital so that we can develop an economy that generates the wealth so that we can take care of our vulnerable, our aged, our children, and so forth. And I think that investor protection is not an end in itself. I think investor confidence is maybe the right term. There's no question that we need a fair game. But if investor protection is your focus, then you can justify just about anything in terms of a plethora of rules. And I think what we've seen is a tremendous increase in the rules. I used to practice securities law 20 years ago. I had a book that I could hold in my hand about that thick. And today, I don't know if you can see it, but this is the book, and it's 3,355 pages. And I know it's smaller print, or it seems like smaller print than 20 years ago when I was working. And just as a way of comparison, it's actually larger than my copy of the study version of the English Standard Version Bible, which actually covers all aspects of life, not just securities regulation. So I think maybe we should be able to focus a little bit. And I think that you've got to ask the question, do we have a bloated commission when we have a lot of different people? 33 years ago, I was the executive assistant to the chairman of the OSC, Stan Beck, who was a very good chairman. Our general counsel's office was one person, Jim Turner on secondment from Tories. Our litigation office was one person, Joe Groya, who's now a fairly well-known securities litigator. We had an articling student, a chairman, a vice chairman, and we would farm out and bring in expertise when the time came. And I think it worked pretty well. And you've got to ask those questions in all those cases. How do we effectively deal with that? And it's similar, actually. We're talking about COVID-19 world. It's almost similar to the questions that we're having about what's the goal of lockdowns. Is it to stop the surge, or is it to remove all cases, incidents of cases? You can do the one by locking down everything, but then you have serious consequences. So you have to have a cost-benefit analysis. I think it's extremely valuable to have these questions. I'm not sure that the OSC should be the engine of economic growth, but I think they should be asking the questions, what things am I doing that might inhibit the growth of our capital markets? And I'll end by this. Our capital markets in 2008 and 9, our level was relatively similar on the TSX to the Dow Jones. Now we're about 16,000, the Dow Jones about 28,000. We have underperformed. I'm not saying that we just underperform because of our securities regulation, of course, but these are the types of questions that we need to be asking: is how do we encourage investment and capital formation in this country? So it's high time we do this also in this sector. Thank you.
Thanks, Rob. Sheila, you wanted to hop in on this question?
I'm almost reluctant to hop in when Rob has spoken because he says it so eloquently and he does it so well. But I have to agree with everything he says. Securities law has changed dramatically in the time that I've been practicing securities law and dealing with it, and it's become complicated and burdensome. I don't know that changing the mandate and adding a new mandate of to increase competition and to increase market growth will necessarily help achieve those objectives. I actually think that the current mandate of the Commission is well set out, and if we focus more on that particular mandate being, I think, investor confidence, capital market efficiency, and instilling confidence in the capital markets, I think that particular purpose is the most important one. And unfortunately, it kind of gets overshadowed by investor protection. And we lose sight of confidence, capital market efficiency. If we just focus on those things, as Rob said, focus on doing things not to necessarily enhance capital raising, but rather make sure you're not impeding capital formation. You're not a detriment to capital raising. Then I think will be a much more vibrant economy. So I wouldn't personally change it, but it certainly can't harm anything if you do. And just before I go back on mute, Cindy, you and your team did an amazing job in record time. I don't think I've ever seen an analysis done as quickly and as thoroughly. Even with all the constraints of COVID, you seem to be able to get, as you said, over 100 people. I looked back at the last report that was done, and I think they only interviewed 65 over 3 years. So you saw in record time over 100 representations, and you came up with 47 extremely thoughtful proposals. And they're provocative, they're thoughtful, they're responsive, and I think that the changes that come out of these will be really, really helpful. So thank you and your team. Great work.
Thanks, Sheila. I think Jos, you want to hop in there as well?
Yeah, just add a couple of thoughts, and I would like to start maybe with the same comments. Heads off to the task force. I do think you guys did a great job, and just to start in a very straightforward and simple way, I probably like over 90% of what I see in there as proposals, and that's pretty high, I think, for a report of this nature. And I maybe miss a couple of things, but I'll come back to those later on. A couple of additional comments I would like to make on top of what Rob and Sheila have been saying is that when I look at the capital markets, we all have used the word vibrant economy, needs a vibrant capital market. And so how do you get your capital market vibrant? I think that there are three things for me that are critical. That is competition, innovation, and transparency. I'm a very big believer also in transparency. And when I look at the situation today, I believe that competition is bridled. Competition is not taking place in a way that allows all that innovation to emerge, and that allows investors or capital raisers or asset collectors to have the best solutions for what they seek to achieve. And that ultimately is detrimental to our environment and to our entire ecosystem. So when you then look at the mandate, I think that the mandate, I've been thinking a lot about that. Should the mandate change? Should it not change? Are we going too far? I think that the mandate should change. And I think that we should include in a very clear way a mandate around competition. There's a role to be played over there. We've experienced it in the past. We have interacted with the Competition Bureau. The Competition Bureau is too far, too slow, and is not on top of these kinds of matters. So I think that we need someone, and obviously a securities regulator is in the best position for me, to play a role over there and to identify those issues and to address them. I think that is important. Fostering capital formation, which is the other element that Cindy, you and the task force put in the recommendations. I'm not sure whether that is indeed the right word to use or the right words to use. I'm not sure that an organization like a securities regulator should be doing that or has the capability of doing that. I would prefer more in line with what Sheila was saying, facilitating capital formation, more something about taking away the hurdles, the issues and the challenges that make it all very, very difficult. And then I really like the word investor confidence. Investor confidence versus investor protection. I think that is indeed more what we should all be thinking about, because that is a tenet of a successful capital markets. And it's a combination of factors that play, not only protecting investors. Last couple of thoughts. What I would love to see as an outcome out of this is less rules, a more principle-based organization, transparency. Show things, make things transparent, because then investors, stakeholders in the industry will see what is happening and will have information. But do that in a measured way. Like, no one is reading a prospectus anymore nowadays. It's too much. You can't keep up with that. So let's come with information that is manageable and digestible. And last but not least, 5 million for administrative fines. Cindy, I know many organizations that would be happy to pay 5 million and then still move ahead with an infraction, because it's an easy way to tackle something that otherwise would be much more costly. So I would go much more aggressively on fines and penalties and sanctions. Last thought, changing the mandate is great, whatever the final outcome is, but it should be more than words. This will only work if the right changes are also being implemented at the level of the organization. And I'm sure it's a topic we'll come back to afterwards, but without the right structure, the right organization, the right people, this will not work.
Thanks, Jos. Lots in that last section that we're going to get back to. Neil, I'm going to hop over to you to kind of move things along. As Jos mentioned, competition. One of the most interesting parts of the report, in my mind, is the suggestion of doing more to support and promote independent dealers. Wondering, I guess, looking at the issue of tied selling and bundling of services, how much of an issue that is for independent dealers like Infor, and how realistic, I guess, giving the OSC a mandate to deal with that really is, when tied selling is already prohibited. Banks will tell you it doesn't happen. So if you could kind of address a little bit about what it does to you and what it does to the ability of independents to compete, and then also how realistic some of the proposals to deal with it are.
Okay, thanks, Mark. Let me add my thanks to the task force. I think probably 40 of these 47 recommendations we at least wholeheartedly agree with, and it's a tribute to the composition of the committee that they really seem to have their pulse on the market and have zeroed in on the issues that are really, really meaningful to market participants, as opposed to, in the past, having these committees perhaps dominated by lawyers and professionals who, while they have their pulse, don't perhaps deal day to day with several of the issues that actually are pertinent to issuers and are pertinent to the dealer community. The task force rightly, I think, targets tied selling as something that diminishes competition. When you look at emerging areas of our economy, technology, mining, most recently in Canada, the whole cannabis sector, traditionally, these are areas that have been fostered, at least initially, by independent dealers. Independent dealers traditionally resonate more with entrepreneurs. They're able to go out on the risk curve and help entrepreneurs raise risk capital, whereas the banks have traditionally been much more reticent to get involved at an earlier stage. And I think for that, you want to encourage independent dealers. We have seen a dramatic shrinking of independent dealers over the last 20 years since the pillars came down. and banks were able to enter the investment banking space and at the same time lend. And one of the reasons, there's other reasons, but one of the primary reasons for that is the tying of lending to investment banking. I think in your opening comments, the banks would, I think you mentioned that the banks will say that that doesn't happen. I actually think that's maybe not the case. I think even the banks today will say that's part of our business. That's how we conduct business. And I think the committee heard from many banks that said that that is how they conduct business today. They look at the customer on a holistic basis in terms of the profits they can derive from that customer, and they bundle those services. So what that means is that as a company matures, it typically will gravitate to a bank because the bank is providing other services, which then dramatically impacts the economic model for independent dealers. And taken to an extreme, I would say, might affect the independent dealer community to such an extent that it actually affects the economy in Ontario, economy across Canada, where independent dealers are not fostering innovation. And so I think that independent dealers play a very, very important role in fostering innovation. And I think the task force got it bang on and said, one of the things that we should be preventing is tied selling. By the way, tied selling is illegal under the Bank Act. And so nobody should have any problem at all with greater monitoring from the Securities Commission to ensure that tied selling does not occur. They went one step further and said that there are also issues where you have a lending relationship and where you are advising on an M&A transaction or advising on a financing. And I think unequivocally where you sit in a lending relationship, you for sure have a conflict as an organization in respect of advising on underwriting and advisory. I think it would be unrealistic in our market, and the task force asked for comments on this. I think it would be unrealistic in our market to say, no, you cannot participate in an underwriting, and no, you cannot participate in an M&A transaction if you are a lender. Having said that, I think having a check on the lender to ensure that the issuer is getting the right advice is important. And so we would argue strenuously that where a lender is a related party under National Policy 33105, that it should then be mandated that there is an independent player, and that independent player could be a bank. It just means that there is a non-lender at the table to give independent advice. So the committee highlights both of those, the inclusion of independence in underwriting, the inclusion of independence in advisory, where there's a strong lending relationship, and we welcome that, and we think it's an important aspect of fostering competition. I should say though, as long as there's a balance. So you didn't hear me say if you're a lender you should be prohibited from participating. There needs to be a balance because you also don't want to increase the cost for issuer clients, and that's it's important that the committee get the balance right. I happen to think they got the balance right in the recommendations, but I'm sure that there'll be a healthy debate around that.
Perhaps I can fire that over to you. Oh, Cindy, you have a comment there. Yeah.
Maybe ask my fellow panel members where they stand on bundling versus tied selling, and where some senior issuers will say, well, I'm getting a cheaper rate on my loan by bundling my services together, so therefore it's actually a benefit to me. And do we have evidence that they're actually getting a cheaper rate on that loan? Like, is there proof of that, or is it just something that we think is happening? And is that something that's really important to our senior issuers or even our medium-sized issuers? And how do we sort of crack that nut a little bit?
Rob, you want to tackle that?
Sure. I've had the opportunity to represent a lot of independent dealers and co-found a small law firm with some excellent entrepreneurial folks. They're still very entrepreneurial, and I think that there's tremendous innovation and entrepreneurialism that comes from an independent sector. Very often, our clients were people that were at big companies that started businesses, and they like working with entrepreneurial firms. And as an issuer, we were a very small issuer at one point, looking for people to help us out. And we tended to use independent dealers. We've been very loyal to them through the years. Now we're in the TSX Composite, and we still are loyal to our dealer network, but also, we have some very good banking relationships. So I think there needs to be a balance here. We have very close relationships with our banks, and we don't just borrow from them. We use them for derivative services, sometimes cash management, that type of thing. We can use them for a mandate, but we're very cognizant of the fact that, there's a lot of people providing services out there. And I think it's certainly a question to be addressed. I have had a discussion with lenders, and this particular was a case in the 2008 and 9 financial crisis when lending kind of stopped, where a major bank basically said, we're going to lend to those people that are effectively providing fees to us. We're a fee-driven bank. Well, they're no longer our lender or one of our lenders. I think that's, I understand it from the bank perspective. Obviously, they'll look at total returns, but I think there has to be a balance here. And I think that, when we're talking so much about the need for innovation, the need to drive and foster growth in our markets, the more market players you can have and encourage, the better. And then once again, just looking at the investor protection for a bit, there's the old capture theory of regulation. And what happens is very often we see policies come from that are effectively supported by major institutions, whether they're institutional investors or lenders or so forth. It says, you should do this for investor protection. You should comply with this over here. And you're putting a tremendous cost on those that may not be able to afford it. And what it really is a way to drive out competition, and that's a problem. Thank you.
Sheila.
And Mark, just a brief comment on that. I agree with Neil that, Cindy, you and your team got it right. There has to be a balance. It would be, I think, naive to think in our economy that we could suggest that companies won't have strong banking relationships. We need that. All companies, as they mature, will develop a strong relationship with one or more banks. You need to have that. Every issuer needs to have that. But issuers need to be encouraged, if they don't already do it, and frankly, I think most issuers are quite smart on this, they have to be encouraged to make sure that they do have some independent views, some independent expressions. Neil will, I know you're already laughing because Neil knows that at my former employer, CI Financial, we always, in addition to our senior bankers, we always made sure that the independents had a place in our investment banking team. They always had an underwriting position, and we always sought independent financial advice as well, for exactly what the reason Neil said. There's an inherent conflict in having the people who have lent you money also giving you financial advice. There will come a time when our interests diverge, or frankly, the interests of our stakeholders and our lenders may diverge. So I think you guys got it right. You can't say no to relationships, but they have to be transparent. We have to be mandated to ensure that we have independent thought that is assisting in our decision making. So well done on you, by you guys. You hit the conflicts. So one last thing before, I know Jos wants to speak. You tackled what I consider to be an extremely difficult issue under the guise of competition, and that's regarding the sales of mutual fund products. As you note in your report, 80% of mutual funds are sold through bank channels. Again, wearing my hat at CI Financial as Canada's largest independent mutual fund company, truly independent mutual fund company, it suffers by not being able to get its products on the bank shelves, or having a difficult time getting products on the bank shelves. And that only became more difficult with enhanced know your client and know your product rules, enhanced compliance obligations. Understandably, the banks are saying, we don't want to have to understand CI's products and CI's risks. We'd rather sell our own products through our own channel. It's less of a compliance burden. So under the guise of compliance and risk aversion and doing the right thing for their clients, there was they moved in favor of their own products. to the detriment of having a balanced product shelf and an opportunity for their advisors to put their clients in products of Fidelity or Investors Group or Sierra or anybody that might have the best particular product for what that client needed. So I think good for you guys to tackle that. Is really, really difficult. But I think you're going in the right direction of encouraging an more open shelf and transparency on the shelf.
Cindy, I think you want to hop in there, and Jos as well. I'll let you go first, Cindy.
Just trying to get my mute button. Sheila, do you think, I think we all agree that there was unintended consequences from know your client and know your product. So should we be looking at know your product and realizing that in some large institutions, know your product isn't being pushed to the advisor, it's being dealt with by the institution, and that is what's caused this narrowing of the product shelves, and therefore, of course, more proprietary product being sold. So should we didn't tackle that or look at that, but is that something that we should look at, that because it seems to have been a very large unintended consequences of know your product?
Is it something you should look at? Yes, the regulators should look at that. The unintended consequences of the compliance regime. They absolutely have to. All of the pricing discussions that happened, when know your product, when know the product and know the client translated into get the client the cheapest product, then we got ourselves into difficulties. But I think it would be naive to think that you can't institutionalize, and companies won't institutionalize the compliance function and the product funnel function. They have to, because there are thousands of products out there. So it's really just a matter of ensuring that everyone has an opportunity, that you can pitch your product, and as you suggested in your report, the banks and others, and frankly, that would, Asante, our dealer at CI, would be in the same boat, have to explain if certain products aren't on their shelf, why. Just so that the clients of those companies are really being protected. We've gotten way down a hole, so I apologize because I've hijacked this down a very, very narrow part of this report.
It's all right. It's an exciting part. Thank you.
Thanks for that. Jos, I think, did you want to make a quick comment on that before we shift along?
Yeah, I'll keep it very short. I think Sheila covered one of the points indeed that I wanted to cover. And by the way, Sheila, we have experienced that when we launched a new type of product called a platform traded fund, where the key reason not to use it was compliance pointing at the regulators and saying the regulators will have an issue with this and we're going to be in trouble. And in fact, it was a better outcome for the investor. So this makes no sense to me. The only other comment that I would like to add, and I see that a bit as a gap, Cindy, like you talk about competition, I think I stressed how important it is. The one area that you don't cover is, sorry to say, then you can expect me to say, is exchanges. I think that in the exchange space, there's a competitive issue also. And let me give you 3 examples that are very simple and very straightforward. One, we see now at the level of the TMX group, tight selling between listing and transfer agent function. Makes it difficult for other parties to compete, whether it is a transfer agent or an exchange, because you get a better price if you take both services at the same time. Is that normal? I'm not sure. And we're talking about, the 800-pound gorilla over here compared to all the other ones. 2, my favorite topic, clear opposition to consolidated market data in Canada, which is not only bad for investors, which is not good for issuers, ETF manufacturers, but it's also anti-competitive because it forces many dealers to put orders on the TSX, because that's the only place where you see them when you trade a TSX listed security. And I'm not talking about what happens when there's a technology issue, and we all remember what happened in February last year. And the third example, the CDCC, the clearinghouse for derivatives. A vibrant capital market needs a vibrant exchange structure, needs a vibrant derivatives market structure. And we all know that we don't have a vibrant derivatives market in Canada. And it is very difficult for competitors to come in. And we all know about an initiative in Toronto for the moment. It's very difficult for them to come in. And derivatives markets are critical to equity markets, and equity markets are critical to everything we know. So I think that's an area that you really should include in your review, and make sure that there too we enable competition and true innovation.
Neil, did I see you wanted to hop in on that one?
Well, I'm just going to make just a quick summary comment before you move on in the space, because I happen to think this is one of the most important areas of the report. The Canadian capital markets needs to increase its sponsorship of entrepreneurship and innovation. We cannot rely solely on the banks to do that. If we allow the banks to continue to tide sell, if we allow the banks to continue to act as a club in underwriting, if we allow them to continue to advise on M&A transactions where they have a material self-interest as a lender, then we're going to be left with 6 distributors and 6 advisors in this country, and perhaps a smattering of international competition. The Canadian financial markets, as Cindy has outlined, is probably the most concentrated in the G20. Already today, it's more concentrated than almost any other capital market in the world. And so I think it makes sense to pull back just a little bit from the 20 years of increasing bank dominance and ensure that there is still an independent voice that is going to support innovation and entrepreneurship. And again, I think the task force got it spot on in terms of striking that balance.
Thanks, Neil. I'm going to move on to the question of expanding investigative and enforcement powers, which is an interesting one. Jos, you've mentioned it several times. Canadian capital markets, especially on the junior side of things, don't always have the best reputation when it comes to things like insider trading, manipulative short selling, that kind of stuff. And it's addressed quite explicitly in the task force report. And I'm wondering, Jos, if you can perhaps take us through whether the expanded powers that are suggested by the task force would do much to, I guess, reduce bad actors in the market, or are there other ways we should be thinking about improving confidence in the markets?
Yeah, I think there are really two components to your question, Mark. That is one, are we setting up here a number of recommendations, or do we have a number of recommendations that will help with enforcement? And then 2, maybe a subcomponent is an area of a lot of discussion, which is short selling. I mean, maybe start with the first one. I think, I said at the beginning, I'm a big believer in principle-based regulation, and I think that comes with a regulator that has the ability to step in in a very meaningful way when someone is breaching those principles and the associated rules. So I think that you need to give them a bigger power. You need to give them the tools to succeed in their investigations. You need to give them the ability to find people accordingly to what they do, and also in a way that will impact them. And I see a lot of recommendations in there that align with that. I think whether it is giving them better access to easier access to documentation, having the ability to freeze assets. I think there's quite a few good recommendations that will make the regulator stronger, and that is important. I still think that the sanctions are not heavy enough, and that we should take it to the next level. In a principle-based environment, in my eyes, you need to work with examples, and you need to deter people from breaking the rules. And trust me, that works much better than a long checkbox of all the things you're not supposed to do, which keeps indeed, which is probably good to employment in a very narrow sector of our industry, but which is not very good to our capital markets overall. Short selling, I find that a lovely topic, and I want to make a couple of comments about it. One, lots of discussion about it. Short selling is back. We should bring the tick rule back in, and so on. So once and for all, let me give you my very strong opinion on that. Short selling is not bad. Short selling is good for market. It's a way to inject information into the market. And I think that if there is something that is wrong with an organization, having the ability to short sell it, nothing wrong with that. Short selling is good because it's also something that enables liquidity providers to participate in the market and inject liquidity when it's needed. When you got market participants that want to buy and there's no liquidity, well, who's going to provide it? Liquidity providers are probably going to short sell. So I think those things are good things. I think that our regulators, they came out with a report around short selling. What is it now? Maybe 4 or 5 months ago, I don't really remember. I think that our regulators came there to the conclusion there was no concerns. My conclusion when I read that report was I agree with the conclusion, but I don't agree with the analysis. And I think that they have an issue over there in looking and understanding the depth of that part of the business. We looked at short selling based on the short positions of dealers in Canada. So we ignored positions with global custodians. We ignored trading that is taking place in the US. About, I don't know, 1,500, 2,000 Canadian stocks are traded in the US. It's not only the 250 plus interlisted on NYSE and NASDAQ. There's thousands plus that are traded on OTC markets over there. We need to have that holistic view and that holistic information. That's not only important to properly support a report, but it's also important for my third point about short selling. And that is something that, I am flabbergasted about. I discovered that in Canada when we entered into the listing business. I never got there with Alpha in my previous life. We got bought by someone. But when we started to get into a listing business, I discovered a form of short selling, which I think is absolutely unacceptable. And that is short selling within the frame of pre-marketing for a private placement. I've looked at a number of cases, a number of scenarios across multiple markets where, for me, there is clear indication that there is short selling taking place based on knowledge about a private placement that is going to take place. You know what I call that? Insider trading. And I do not understand why our regulators are not addressing that, because it's bad for the company. It's bad for the investors who trade against a short seller. It's bad for the shareholders overall. And that is really, we've been known for fighting inappropriate strategies that we see in the trading space. We're known for fighting the issue of consolidated market data in Canada. I can tell you that this one is the third issue that we are going to spend, and I'm going to spend a lot of time on in the coming months and years.
Neil, you wanted to comment on that?
So I'm going to say I agree completely with almost everything that Josh said. So first of all, dealing with enforcement, it's not for a lack of resources. The OSC is very, very well funded. They have a massive surplus at their disposal. Yet I think we lag in a significant way enforcement relative to the US. So I think, again, the task force did a lot in terms of decreasing complexity, increasing competition, allowing issuers to access capital markets through, for instance, testing the waters, pre-marketing, and things like that. The flip side of that is you have to have strong enforcement. If you're going to decrease the regulatory burden, then I think you need to have a very, very vigilant eye at the OSC to take out bad actors. For the life of me, I can see nothing wrong with going to visit investors and asking them if they are interested in participating in a particular issue, and then putting that issue to the company. I think that should be allowed. Currently today, it's not, except in very specific circumstances. The committee task force said, yes, we think that should be allowed. The flip side of that is, if bad actors use that information to short stock in advance of an issue, that is insider trading. And so if we're gonna give on the competition side, then we also need to be very vigilant, I think, on the enforcement side. And unfortunately, I think that when you look at regulatory enforcement in not just in Ontario, but in Canada, we dramatically lag the US. There are countless examples of Canadian companies being taken rightfully to task in the United States and not being taken to task by our regulators. And so I think it's important for sure to beef up the enforcement side. And let me just make one final comment. And I also think it's very important that we separate, as the task force has said, the administrative function from the adjudication function. The impact that staff has and the power that staff has because of their close relationship with the adjudication side, I think is not helpful. And I think that staff needs to be there to be an advocate for enforcement, an advocate for the administrative function. But at the end of the day, you need an independent body, and it should be in a separate building. It shouldn't be connected to staff. It should be like it should be a specialized court. We recently had an issue where the OSC chose not to take it on, where staff said no, and in fact, we might even oppose you if you bring it, which is a daunting task. Then you get sent to the Ontario court, and there you have, you often come across judges who do not have a great degree of familiarity with commercial issues. In our particular instance, we were given 15 minutes to make arguments in a very complex corporate case. That matter for sure should have been in front of an OSC panel. And it would have been, I think, if it were a separate body from the administrative side of the house. So again, I think the task force has walked this tightrope of loosening capital markets to create ease of access, but at the same time, bringing in some provisions or at least highlighting some real issues around the current environment where people are shorting stocks and ahead of issues, and where the OSC staff has undue influence over the judicial side of the house.
Thanks, Neil. Is everybody still here? I think Neil may
Yeah.
cut for a second, but sounds like everybody's back on. Yeah, go ahead, Rob.
Yeah, very briefly, I agree with a lot of that. A regulator with an enforcement power has to focus on the bad actors and be able to really nail them, whether they're with issuers or market participants or people involved in a proxy fight, spreading rumors and that type of stuff. You've got to be able to enforce it, number one, and with a big penalty, like $100 million penalty, and a CEO loses the job of a financial institution or something like that, like you would see in the United States. But at the same time, you shouldn't throw the book at people for a parking ticket. And if you look at the effective enforcement over the last 30 years, most of the convictions are people that, very often made a mistake. And I think, you got to focus your resources where it is. If you have principles-based regulation, focus on the bad actors. The really bad actors will learn really quickly. Thank you.
Great. Yeah, Cindy, I'll let you hop in. We're getting pretty low on time, and we haven't really got
No problem.
any questions.
I just wanted to say that a lot of the enforcement stuff you're talking about really goes to investor confidence. And investor confidence in our markets is hurt if everyone thinks that people are shorting in advance of offerings and buying it back on deals. Like these types of situations really hurt investor confidence, and we lose people. We don't attract capital to Ontario if there isn't a level playing field, and we don't have the confidence in the system. So I think from our task force perspective and my personal perspective, that these points are very important. So thank you.
Thanks, Cindy. Jos, I'll let you hop in too. Yeah.
Yeah, we're just going to say, and you should ask what international investors think about that, because they see that too.
Great. We only have, I think, about 7 minutes left, and the conversation's been so good. We haven't got to many of the questions, but some questions coming in, and ones that I also wanted to ask was about the diversity initiatives. There's a sense that the comply or explain approach has not led to increasing diversity, or at least the pace of increasing diversity in corporate Canada that could be hoped for. Wondering, I guess, though, if the task force's approach to suggesting targets and disclosure around those targets is the right way to go, or does that perhaps overstep what regulators really should be doing? I know, Rob, you wanted to say something on this one.
I think I was invited to say something on it, so let me do the politically incorrect statement. I mean, what does this have to do with securities regulation? This is the paternalistic, politically correct policy making that I think we want to avoid. Now, having said that, okay, and that's the politically incorrect statement. We get diversity and inclusion and sustainability at our company, and I think a lot of companies are like it. Our fundamental principle is the golden rule principle: treat everyone with dignity and respect. We have summer student hiring programs where 50% of the hirees have to be women, 75% have to be minorities, including women. We've got diversity purchasing practices where we spend $200 million a year buying parts from minority-owned companies, particularly in the United States, and we've got awards. And we have a board where we have 6 independent directors, and any target, by the way, should just focus on the independent directors, because the CEO on a board is a different issue. And you know, the 2 women on our board are great. One was the Minister of the Status for Women, one was the Chief Scientist of Ontario, but the 4 guys are great too. And they all got 99% approval ratings from shareholders. So I think, you know, that's an area that I don't think is a Securities Commission mandate. It's certainly one that's open for discussion. And by the way, we have lots of discussions with investor organizations and all kinds of other folks, and that is an issue in every boardroom, which is what directorships do I want to present to people? What is my disclosure stuff? I actually think we do a pretty good job on it, but I don't think it should be a regulation from the Securities Commission. Thank you.
Sheila, over to you.
Yeah, and I will be brief because I know you are running out of time and would like to get to other questions. Bob hit the nail on the head once again. I am all for diversity. I've been the beneficiary of diversity initiatives. And I do believe that better decisions are made through a diverse group of people, but I do not think that this is a matter that deserves securities regulatory attention. I don't think it goes to investor protection. I don't think it goes to capital markets. It's really important. And I don't think that there is a boardroom in this country that doesn't talk about it and think about it. I don't think that there's a company that doesn't think about it from a recruiting point of view and a mentorship and advancement point of view. I think that the initiatives that the OSC took now 4 years ago were great ones and have socialized the idea and sensitized all of us to it. That will continue, but change does take time because board renewal takes time. And that's one of the other things your team focused on, Cindy, and I'm going to make a comment on that in a minute. I don't believe that we'll achieve the ultimate objective, which is true diversity, with a sledgehammer approach of targets and deadlines. I do think that having to explain to your shareholder base and the world at large why your board is comprised the way it is will go miles towards us achieving the ultimate goal. And knowing that recruiting from the biggest possible group of people can only be better. You're only going to get the best and the brightest if you encourage everyone to join your organization. So I think we will get there, but I don't like the idea of the targets, and I don't see this as an OSC or securities regulatory initiative. You also have chosen to wade into for board members, which I don't believe is a securities regulatory issue either. I think it's a matter of great importance to our stakeholders, certainly. And again, it's something that we're all keenly aware of around the board table. That it gets very difficult for directors to know when they're past their best before date. And so term limits help with that and help with those difficult discussions. And regular reviews do that as well. But I think having the regulators put a hard line at 10 ignores the fact that a CEO will always be on the board. And some CEOs have a tenure of more than 10 years. Sometimes other executives on the board, and you need their guidance and their involvement. Or you may have founding shareholders who are on the board, and they they have a right to stay longer. They're different categories. So this one size fits all doesn't work, but requiring us to disclose whether or not we have term limits, which is currently part of securities law, helps achieve an objective of focusing you on it, making you explain if you don't have term limits, why you don't. If you do, why you chose 15, which most banks have, or 12, which many of our insurance companies have. So I don't think you need to be wading into those areas. I think the OSC has so much that they need to do. Focus on objectives, focus on where they're going, and stay out of things that others can handle for them. Sorry, Eric. Uh-oh.
I'm going to give Cindy, we were very close on time here, so you got 30 seconds, Cindy, and then I have to wrap it up.
No problem. I would ask you, what's the next step from comply or explain if you don't want hard targets? And I would ask you to consider the fact that our senior issuers themselves, and under pressure from the largest institution in the country, have of course moved themselves to over 30% women. But when you look at the bottom end and when you look at the smaller issuers, it hasn't happened yet. And if diverse boards make good decisions, and that's good for shareholders, how do we get our smaller issuers to come along? And what is it? Where do we go from comply or explain? That's my question.
Thank you so much, Cindy. Glad we got that final point in, and I'm going to pass it back over to Eric to wrap things up.
Brilliant. Thank you, Mark. Given the sheer size of the report, the recommendations made, and the clear impact that the CMMT is working to drive through this review, it shouldn't be a surprise. So obviously we had tremendous turnout over lunch today. It's a critical topic for Canada, for our capital markets, and the future of our economy. I'll maybe stress, I mentioned at the beginning, you have only a few days to write in and comment as a part of the formal comment period. Please, if you have an interest in only one, several, or multiple topics, ensure that your voice is heard and that you submit on time this Monday, September the 7th. You can expect to hear from us again on this topic, no doubt, and we look forward to continuing to drive change through our industry with your support. To our audience, thank you for your time today, for showing your interest in this topic. To our panelists, Rob, Neil, Sheila, Cindy, and Jos, thank you for your insights, for sharing your experiences, views, and vision for the future. Cindy, of course, special thanks for your keynote and yours and the CMMT's efforts in the report. To our moderator, Mark, thank you for an expert navigation of a large, multi-dimensional discussion today, expertly navigated. And to the NEO team, thank you for putting today's event together in coordination with our sponsors, Ostlers, Miller Thomson, Wildeboer, BLG, Odyssey Trust, Dentons, and Baker McKenzie. Truly, we appreciate your support and vote for change. With that, we're 2 minutes over. Have a terrific afternoon, everyone. Enjoy your last few days of summer, and thank you all for your time today.
Thank you.